Hi, I'm Jimmy. In this video, we're looking at the dividend stocks that are going to make up our dividend portfolio from our Dow 30 analysis. If you're new to this channel, well, we've been doing an analysis of all 30 companies in the Dow Jones Industrial Average with the intention of taking that analysis and building three different portfolios: a value, a dividend, and a growth portfolio. This is the dividend portfolio. So my goal here is not to simply pick the highest dividend paying stocks, but instead to put together a portfolio of dividend paying stocks that have consistent dividends that are sustainable, and the whole portfolio is well positioned to do at least decent in today's environment, which, let's face it, could see a market pullback or a market crash, whatever you want to call it. That could happen over the next couple of years. Now, in picking these dividend stocks, I had to mostly limit myself to the 30 companies in the Dow, since I wanted people to be able to see the research process behind each of the companies. So every dividend paying stock that we talk about in this video, well, there's a research video behind that. You can find all those in the link in the description below. Some of them, we've been working on this for a little while, so some of them are older than others. If there's any that you think should be updated, please let me know in the comments below, and we'll be sure to do that. Okay, now let's get rolling. So this is the breakdown by sector for all the companies. There are 16 different companies in the portfolio, all from the Dow. We're going to have a few additions to this portfolio from non-Dow companies, but we'll get to those in a minute. So as you can see, I try to diversify amongst a bunch of different sectors to try to add the benefits of diversification. And then when picking the individual names, I try to weigh things like their valuation, their business model, the dividend yield, the dividend payout ratio, dividend growth rate, debt, cash, things like that. Okay, so now let's get to the individual companies. The first one from the energy sector, this one is Chevron. Chevron has a dividend yield of a bit more than 4%, and this is Chevron's current dividend payout ratio. So as we can see, the dividend payout ratio spiked back when oil prices went a bit crazy back in 2015, but it seems that the dividend payout ratio has stabilized since then. Now, when we switch over to their dividend per share, we can see the dividend per share has grown nicely over the past few years. Same issue when oil prices went nuts in 2015. You can see they sort of held things stagnant a bit, but then it started moving up again recently. Switching back to the whole portfolio, now our next company is Exxon Mobil from the energy sector. And they have a slightly better dividend yield than Chevron does, at a dividend yield just short of 5%. But that may be partially due to the fact that they didn't slow their dividend back when Chevron did. But they probably should have, because when we switch over to the dividend payout ratio, this is what that looks like. And just so we're all on the same page, these numbers, these right here are in quarterly numbers, and this 100 line right here, well, this means that if the bar reaches 100, that is 100% of net profits. That would mean that the company brought in whatever profits they brought in, they paid out 100% of it. If the number is greater than 100%, like it was right here, well, that would mean that the company paid out more profits than they brought in. Now, I know some people like to look at this from an annual perspective, but I wanted to see how it looked on an individual quarter basis, see if it gave us any extra insight. But overall, what we want is the lower the better with the dividend payout ratio. Now, this recent spike here, I know that Exxon had a bunch of maintenance that they had to do in their refineries over the past quarter, and that single quarter had a huge spike in it. Now, I'm not too worried about that because I know a lot of those are short-term expenses that should go away soon. I expect over the long term for them to maintain profitability fairly well. Plus, the stock is down like 15% since they came out with earnings, so it seems like a good time to add this to a portfolio. Okay, moving on to our next segment. Next up, we have communications, and here we went with Verizon. Now, I'm a big fan of Verizon, and they have a dividend yield of a bit more than 4%, and it's been growing fairly consistently over the past few years. And their dividend payout ratio has been trending lower, which is a good thing for their stock. And one more thing I want to bring out, if we switch back to their dividend per share chart, well, here, if we were to add a line to the average dividend growth rate over this time period, and then we were to compare that to the average growth of the earnings per share. So in theory, if the earnings per share growth is greater than the dividends per share growth, that would imply a longer term sustainability of that growth rate of the dividend. In this case, there is a gap, so that would even imply that at some point, perhaps Verizon could increase their dividend, or perhaps do a one-time special dividend, or maybe they keep that cash and they simply make the company grow faster, which in theory would lead to higher stock prices. Now, I just wanted to bring that out as one of the metrics. I probably won't pull that chart up again, but I just want to bring it out as one of the metrics to consider. Okay, now jumping over to technology, The first company there is Apple. Apple has a dividend yield of just short of 2%, but that dividend has grown nicely ever since they started paying out a dividend a few years back. And I would expect to continue to see their dividend growth be at a pretty good pace. Then if we switch over to their dividend payout ratio, well, their dividend payout ratio has been trending between 20 and 30%, which I think is a good level for both growth for the company and a reasonable amount for investors to get back. Okay, now back to the whole portfolio. Now here, I just want to bring out that I've assumed that we invested an equal amount in each company. So 6.25% goes into every holding. So the next company is Intel. Now, Intel's had solid dividend growth over the past few years, and its dividend payout ratio is heading in the right direction as well. Then we have Microsoft. Microsoft has been growing their dividends at a good rate, and their dividend payout ratio is also getting better, much like Intel was. Now we shift over to consumer non-cyclical companies. Now these companies should do particularly well if the market does start to head lower. Now here we have Johnson & Johnson, Merck, and Pfizer. Now, I think that each of these three companies could do very well. This entire sector should do very well if the market ever ends up in trouble. They're all blue chip companies, and I expect for them to continue to provide a stable dividend. Each of them provides somewhere between 2.5% and 3.5%. They also have decent dividend payout ratios. Then we move over to cyclical companies. Now here we have Home Depot, McDonald's, and Walgreens. These companies are a bit more vulnerable when it comes to a pullback in the market, but Home Depot, as an example, I believe is a very solid company. They have good, solid dividend per share growth, and they have a reasonable dividend payout ratio. McDonald's is in a similar position with a very solid dividend per share growth and a good or respectable dividend payout ratio. Walgreens, same thing, solid growth and reasonable dividend payout ratio. But again, because of the nature of these types of businesses, if the economy were to slow, then these are likely to be the first companies that get hit, or at least the ones that get hit the most. Now, moving over to the industrials, there I like both Caterpillar and United Technologies. And to prevent this video from getting too long, well, I'm going to skip the additional charts for now, and I'm going to move right to the financial segment where we have American Express and Visa. Now, all four of these companies should hold their own in the event that the market were to pull back, and they all pay decent dividend yields. It's likely that they won't hold up as well as the non-cyclical companies do, but they should do better than the cyclical companies. And I apologize for skipping the additional charts. I'm trying to move along as quickly as I can without dragging on the video too much. But if you're curious, all four of these companies are showing decent dividend per share growth, and they are showing pretty good dividend payout ratios. Their dividend payout ratio for the industrial companies are about in line with the industry average, and they're in the low 30% range, while the financial companies, also in line with their industry average, are in the low 20s to high teen percentage range. Okay, so we're all good there. Those are the 16 main holdings for this dividend portfolio. Now, I rushed through some of the end there because I wanted to get through some potential add-ons to this dividend portfolio. So we have 16 companies from 7 different sectors. So I'm fairly happy with our diversification. And like I said, I equally weighted all of these companies. With an equal weighting, the dividend yield for the entire portfolio comes out to be about 2.7%. But what if we wanted to add a bit more from a yield perspective? So I have a few ideas for that. The first company I'd like to add is AT&T to our communications sector. There, I think that this is a good diversifier to Verizon, and they have a dividend yield of more than 6.5%. Now, AT&T does have a ton of debt, and I actually did 2 different videos on AT&T, one on the company itself and one specifically on their debt, like in the description below if you're interested. So AT&T should help from a diversifying standpoint and a yield perspective. Next up, I would like to add CVS. Now, CVS, you may remember that I did the video on Walgreens and CVS, I combined them into one video. And I actually like CVS's position in the market a bit more than Walgreens, mostly because they bought Aetna. Now, when they bought Aetna, we could really make the case that they don't belong here, but they belong in the non-cyclical sector. That would mean that the non-cyclical sector gets even stronger since Aetna is a health insurance company, and that would add more stability to the portfolio. Okay, the next interesting company is Kimberly-Clark. Kimberly-Clark has a dividend yield of more than 3% and is once again sitting in the consumer non-cyclical category. And as you can see, I'm a big fan of being defensive at this time in the market. To me, it's smart considering the turmoil in the market and the potential for an economic downturn. Okay, next, moving back to the industrial sector, there we're going to add Emerson Electric. Now, Emerson Electric has a dividend yield of right around 3%. And overall, I like their position in the market, and I think that they're a good addition to this entire portfolio. And if you're wondering, the videos for both Emerson Electric and Kimberly-Clark can be found in the 5 dividend stocks for 2019 video that we did. Okay, so overall, that gives us 20 companies for our dividend portfolio, and assuming 5% go into each company that's equally weighted, we end up with a dividend yield of about 3% for this entire portfolio. And finally, and this is the last piece, and this is something that I think could benefit a lot of us if we want to add a bit more diversification, and that is to add an ETF to this entire portfolio. And for that ETF, I actually like the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL. And although they have a lot of companies that we already have in their portfolio, they do hold 58 total companies, and that would add even more diversification to our entire portfolio. So right now, their dividend yield is a bit over 2%. And for anybody, if you're ever looking to start building a dividend portfolio, that could be a great place to start. Start there and then start adding companies to it. So I hope you found this interesting. And if the dividend yield wasn't quite high enough for you, let me know in the comments below, because I'd be curious about putting together a high dividend yield portfolio. So let me know what you think in the comments below. If you haven't done so yet, hit the subscribe button, hit the thumbs up. Thank you for sticking with me all the way to the end of the video, and I'll see you in the next video.